should be. All right, if not, whoop-de-doo. We'll figure it out. Let's start recording from here too. I'll do it that way. Welcome to the Ironworth Trading Show. I'm your host, Coach Price. This is not financial advice. A 50% loss, you guys, ladies and gentlemen, requires you to have 100% gain just to break even. A 90% loss requires you to have a 900% gain. 900%. Let that sink. Okay? So, a lot of people never heard that math, and it changes everything about how you think about money. Again, good morning, everyone. Welcome to Ironworth Trading. I'm your host, Coach Price, and tonight we're going full-fledged. I'm not going to hold back. I'm going to make sure. Why did I say tonight? Anyways, we're going to talk about the stuff that ain't nobody teach you in school, right? Today going to be one of the most valuable days you ever spent here at Ironworth Trading. So put your phone where it need to be, which is you taking notes on it if that's what you're using it for, right? But we're going to cover literally everything that's about to come. Now, here's the roadmap. Capital protection. We're going to talk about capital protection, the math, the mechanics, trading discipline. So I've mapped it out to where it's basically 6 traps that destroy most traders, okay? And I want to show y'all how to build a system that's going to make discipline automatic for you. That's right. Yep. So this is pretty much me warning you about the market because there are some historical parallels that we want to pay attention to. And there are some signals right now that's showing. And I want to tell you exactly how to prepare. We got Bitcoin and crypto, you know what I'm saying? Certain institutions doing certain things. Let me get my shit together. Pardon me, y'all. 1 second. But if y'all stay here long enough, you're going to get the information. Let me get my drink. Y'all better get y'all beverage. All right, y'all ready? Hit the subscribe button. Hit the like button for me on this video. The single most important concept in all of investing, y'all, is not the most exciting. It's the most important. But it's protecting what you already have. Do y'all agree with that statement? See, most people come in thinking investing is about making big returns, getting rich fast. That shit gonna get you smoked in these markets. You want to become a professional trader or an investor, you need to think about not losing money first, okay, and making money second. Always you come at it that way first, right? You lose 10%, your ass gonna need 11% just to get back to even. You lose 20%, you're gonna need 25% just to recover. You lose 33%, you need 50% to recover. You lose 50%, you need 100% to recover. You gotta double your money, right? You lose 75%, you need 300% to recover. You lose 90, you need 900% to recover. Been there, done that. You don't want to do it. Yeah, y'all, you don't want to go through that shit. This is called asymmetric losses. Asymmetric loss. Basically, it's the mathematics of losing, okay? So the mathematics of losing is brutal, and most people do not understand this shit until it's too late. And yeah, the further you fall, the harder and the longer the climb back up that hill is. Okay, so you got $20. Let's say you got $20. Who in the chat? Who in the chat right now? One of my people in the chat, y'all. Drop your name for me in the comment section so I know who rocking with me. But let's say you got 20 bands. You got 20 grand, right? You got 20,000. And you have a bad run. You take some emotional trades. You force a couple of entries, and you held some losers, right? Now you lose. Let's say you lose 50%. Now you got 10,000. To get back to 20,000, you need 100% return. Making 10% a year, a very good return, takes over 7 years, y'all. And 7 years to get back to where you started. 7 years. And what make it worse, your trading psychology is destroyed during that recovery. Yeah, you ain't gonna feel like you doing right. Every time you take a loss, every loss is gonna feel like confirmation that you can't do this shit, and that ain't true. Like, you trading from fear at that point and desperation instead of confidence and clarity. Now, Warren Buffett gave us 2 rules. Y'all ready? Pull out your pen if you ain't already taking notes. I'm finna give you 2 rules Warren Buffett gave us. If you don't know who Warren Buffett is, he one of the best investors of all time. One of them. He gave us 2 rules. Rule number 1, do not lose money. Rule number 2, do not forget rule number 1. That's the entire philosophy of the greatest investor in human history in 2 sentences. One of them. Now, every serious professional has independently arrived at the same conclusion. Everybody that trade for real at some point then got to that same conclusion. Protect the bag, protect the capital, secure the security. You live to trade another day. The money you do not lose is just as valuable as the money you make. I'm going to say that again. The money you do not lose is just as valuable as the money you make. And over time, it's really more valuable once you think about it because of compounding. It's just as valuable as the money. I had to go and see if I was, I had to go and make sure my live was working. Let me see. Let me share this out real quick. Share this to the Discord. I was supposed to go live last night, but I fell asleep. Let me share my live out, y'all. That's what the pause is about. Pardon me. Early bird gets the worm. I know everybody probably sleeping in because it's Saturday morning. What's up, y'all? Who in the chat? Who in the chat? Who in the chat? Alright, everybody else will get it. They'll be alright. They'll be alright. So yeah, like I was saying, Warren Buffett gave us 2 rules. Rule number 1, do not lose money. Rule number 2, do not forget rule number 1. Hey y'all, let me get another mic check. Mic check, can y'all hear me? Cause I have to use my YouTube and I want to know, how do I sound on somebody else's device? Should be the same as it sounded on mine, but come on, let me know. Talk to me. Help me out with the engagement. Whoever in the chat right now, say something to me. You know, when we on TikTok, we got hundreds of viewers in there, maybe even thousands sometimes. But this is my first time really going live on TikTok, so it's a little. I mean, on YouTube. Sorry, pardon me. So look, write this down or keep this in mind. The goal is not to make the most money. The goal is to stay in the game long enough for compounding to work. Now I want y'all to write this in the chat. I want y'all to write this down in the comment section when you hear me ask you this question. What percentage of your account have you lost on a single bad trade? And be honest. This is a safe space. I'm gonna read the comments. Now, I want to talk about the 3 pillars of capital protection, right? So there are the actual mechanics that protect your account that you are unaware of, okay? The 3 pillars of capital protection. This is what you deal with in real trading. Now, we dealing with position sizing, stop losses, and knowing when not to trade. Yeah, pillar number 1, position sizing. Never risk more than 1 to 2% of your total account on a single trade. If you got 10 bands, if I only got $10,000 in my account, 1% is how much? 1% is $100. So that's your maximum loss per trade. That's it. Full stop loss. At 1% risk per trade, you can lose 50 consecutive trades and still have 60% of your account. At 10% risk per trade, you are completely broke after just 10 losses. See, small, consistent risk is what's going to keep you alive. But when you take them big ass risk, them big reckless risks, that's going to kill your account. Okay? So the position size formula that I like to keep in mind, the maximum dollar risk divided by distance from entry to stop equals share quantity. $10,000 account, 1% risk, $100 max loss. I'm gonna get in entry at $50, stop at $48, $2 risk per trade. Sorry, $2 risk per share. So 100 divided by 2 equals 50 shares. Write this shit down if you need to. Map it out. 100 divided by 2 equals 50 shares. You lose exactly $100 if stopped out. Y'all, the numbers gonna vary based on what your account is. The numbers gonna vary based on how much the contract costs. Those numbers gonna vary based on how many contracts you bought. And your risk tolerance and all that shit. But guess what? If I get in at $100 and I think it's going to 103, I'm gonna get out when it's at 98, 99. Yeah. Now, which leads me to pillar number 2, stop losses. Predetermined. You know the key word in predetermined is pre. Okay, a predetermined price at which you exit a losing trade. You're going to set this before you enter the trade. This is not optional. This is the single most important risk management tool that you have. The discipline is set when you set the stop loss before you enter the trade. If you listen, if price reaches this level, right, I'm wrong. Let's say I think SPY finna go up to 666. It's at 663. If it goes to 661, I'm wrong. At the point where it gets to 658 and you still holding it, something wrong with you. Okay? And the only thing it is you ain't got no discipline enough to say, hey, I was wrong if it gets to this level. But if it reached that level, I'm wrong. I'm out. No renegotiating. Ain't no hoping. A stop loss is not a loss. It is the cost of doing business. This is the price that we pay to stay in the game, if y'all didn't know. Now that leads me to the next pillar. You got to know when not to trade. Not every day is a trading day. I don't know. If ain't nobody told you, I'll be the first to tell you. See, some days, the best trade that you can make is no trade at all. I want you to, keep that in mind. All right? Now, where we at? I think I ain't went over everything. Wait on some people to come in. All right, so I got some homework for y'all. I want y'all to calculate exactly what 1% of your account is right now. Okay? Go look at your account and do what you got to do. Pull out a calculator, ask Chat, GPT, Google, whatever. But you need to calculate exactly what 1% of your account is right now. Put it on a sticky note. Put it right next to your screen. Do what you need to do. But that's your maximum loss per trade starting today. It's non-negotiable. I had to look for that in my notes. Like, I know I had something for them. That is what I had for y'all. That'll be helpful. So, and I also want y'all to let me know in the comment section while you listening to this video, are you using stop losses on every single trade that you take? Yes or no? Let me know. Let me know. I'm asking you a good question that you need to be asking yourself. A lot of people say don't trade with them. I don't listen to those type of people because if you let me, is it your money? Oh, okay. If it ain't your money, I don't want to hear shit you got to say. Now, compounding is the most powerful force in finance. Did y'all know that Albert Einstein, which is one of the smartest men we've ever known to exist, one of them, Einstein called it the eighth wonder of the world, and it's only true when it works for you, when you never give it back. Like, it only truly works when you never give it back. You give it back, it didn't work. So let's say one person got, let's say Trader A, we're gonna call him Trader A. Trader A got $10,000, and they make 20% the first year, and then they lose 15% the next year, and then they make 20% the third year. After 3 years, they up about 22%. Right? So Trader B, same 10,000, make 15% every year with no major drawdown. After 3 years, they up over 52%. Right? They ain't had no spectacular years, but they just had some consistency. No big losses, just consistency. So 10 years of 15% consistently on $10,000 over $40,000. I would rather have 10 years of 15% consistently on 10,000 over having 40 bands. See, 4 times the starting capital. It came from you investing 10 years, and then you got 15% consistently on that little 10 bands. Where else was you finna make over $40,000 doing something like that? You made 4 times your starting capital. You ain't have to be a genius to do that. You was just disciplined, and it's compound. Now, I ain't telling you to do that. It's better ways. If you don't understand what I'm saying is, basically the money that you put in there is going to make money for you. And then that money is going to make money for you too. You might have a better understanding of it than I do. Okay? I'm just pointing you in the right direction. I never claimed to be a genius, ladies and gentlemen. Now, the wealthy do not get wealthy making big ass bets. We gonna do what rich people do, cause it ain't gonna stop working just cause we tried it, right? So they get wealthy making consistent returns and never losing the base. Stop measuring success by your best trade. I want you to start measuring it by your consistency and how much consistency you got over time. Compound 10% per year on your current investable amount. Check where you end up at in 5 or 10, 20 years, right? And just be consistent. Be consistent. And cut out all that FOMO shit and strategy hopping. All right, so we finna talk about what happened in the market real quick. I think I talked about psychology enough. I had a lot to say. Now, let's talk about Jim Cramer. Hold on. Jim Cramer, where he at? Where is it? Here you go. Jim Cramer is comparing this market to 2007. Robert Kiyosaki, where he at? Robert Kiyosaki says something too, if I ain't mistaken. Nonetheless, Robert Kiyosaki, the guy that wrote Rich Dad Poor Dad, he says the largest crash in history may be approaching. Now, whether these specific predictions are right or wrong, the warning signals that preceded 2008 are worth understanding. They basically saying that what's happening now is damn near a result of is still a result of what happened back in 2008. But history does not repeat exactly, right? But it does rhyme. And right now it is rhyming. Right now it's spitting. So 2007, we had the asset prices at all-time highs. Let's see if we can even go back that far real quick. Yeah, so from 2002 to 2007, the market grew like that. And then from 2007 to 2008, like it just shitted on itself, okay? Starting in 2007, right there. All right, so the shit was at an all-time high. Consumer debt at record levels. Interest rates rising for 2 years. Okay, confidence was high. People felt rich on paper. The prevailing wisdom was that it was different this time. Then 2008 happened. That whole year. Matter of fact, yeah, let's just highlight it. Oh, matter of fact, I want to measure it. Data and price range. So for about a year, it went down a shit ton. Damn near a trillion on the volume within a year. Anyways, it dropped over 56%. Trillions of dollars of wealth wiped out. People planning to retire at 65 had to take their ass back to work. And the people who prepared, not because they were smarter, but because they took warning signs serious. They survived. They had cash. They bought assets at 56, 70% discounts. See what I'm saying? And the recovery made them wealthy. The biggest wealth transfers in history happens during crashes, y'all. It happens during a market crash. So to people who are prepared, if you stay ready, you don't have to get ready. Remember that when this shit started to happen, because as of right now, this little spot right here, that's where we at right now. This is where we at on the S&P, figuratively speaking. Like, we went up and we've kind of started to top. Now, if according to everybody's calculations, this is what's on the way. So we'll see, right? So 5 signals right now. We got valuations historically elevated. You paying premium for every dollar of earnings. Number 2, higher rates for longer, putting pressure on borrowers, companies, housings. Number 3, geopolitical uncertainty. That shit's starting to increase all of this fragility that's in the market. But as far as putting pressure on the borrowers, it's also pressure that's being put on housing and companies. Like I said, we got consumer savings being depleted. Credit card use rising. The list goes on. Right, I can keep going on. These are not predictions. This is the conditions that we in right now. So, what do? Do you barbecue or you mildew? I know one thing you don't do. You don't panic sell. You don't try to time a crash either. We not. Let me see where we at right now. I just go right back there. Yeah. So even if I show you on a 6-month chart, that's what I mean by we right back at that same time. Year to date. There we go. Yep. Right before. Let's see. Let's go to 2007 and get that same shit I just drew. Oh, it ain't there no more. Let's get this. Let's measure this real quick. Let's see what would happen if we put this much time on SPY right now. It might be an easy way to do this too, so don't talk shit, y'all. Don't talk shit. I may be on to something. I don't wait on nobody to tell me though, so I use my brain. Say, hey Cedric, if it fell that low before, and they thinking that this is just like that, so let's see if it is. If it is anything like that, then how much drawdown could we really be looking at here? There was definitely a faster way to do this, but it's okay. I tell you what. See how stupid? Oh, okay, you ain't stupid, Cedric. It's okay, buddy. Ooh, child. Things are gonna get easier. Looking at. All right, let me see. Let's go to a daily. Don't start. All right, let's see. If SPY drop from here, well, from where it dropped, from where it's dropping it now. Can't be the same. It was more than that. Was it? It was more than that. Hold on. Now I'm forcing shit because that it wasn't more than that. So yeah, I'm just gonna look for 620, right? But either way go, we don't try to time a crash because that's what I just tried to do, time a crash. You apply everything we covered, right? We review position sizes, we cover stop losses, we eliminate over leveraging, and we make sure that we stay cash heavy and know exactly what you own and why you own it. Yeah. I was thinking it was going down anyways. Like, let's just be clear. But I'm using previous levels. What I will realistically do though is use previous levels of support. 650. SPY could go down at least to 650 for sure. But we have to break below 650 to really be. Oh, the sky is falling. The sky is falling. Right? SPY could drop all the way back down to 600. But that's. I was trying to time that shit back here. Don't do that. Don't try to time it. Don't do it. You know, I thought it was gonna happen back here. It went down all the way down. Don't do it. Don't do it to yourself. So think in scenarios. The market continues higher. You participate with proper risk management. If it corrects significantly and starts, doing what it do when it corrects, your drawdown is limited, and you gotta have capital to be able to buy these discounts. Cause then you're gonna be saying, Coach, you said buy the dip, but buy the dip with what? I bought the dip and the dip kept dipping. So either scenario, you are in a position of strength, right? When you do it that way, that's the goal. You don't want to be trying to predict. You just want to prepare. Now, the guy that wrote Rich Dad Poor Dad, Robert Kiyosaki, he recommends gold, silver, Bitcoin, Ethereum, and energy assets to protect against these situations that we're about to go through, against currency debasement and systematic pressure, systemic risk. You need diversifiers right now. Insurance policies, let's call them that. Not necessarily life insurance, even though a lot of y'all need that too, but I mean like treating certain assets like insurances, right? So a portion that zigged when everything else zagged. That's what you need. A portion of your shit that zigged when everything else zagged. So go through your portfolio this week and ask yourself, am I too much? Am I over leveraged right here? Am I over concentrated here? Do I got enough cash for some shit pop off that I can take advantage of it? Do I have stop losses on every position? If the answer to any of these is no, fix it before the market forces you to. Okay? Fix it before the market forces you to.